All right, welcome to The Explainer. Today, we're jumping into a story that, honestly, seems to defy Economics 101. Picture this. On September 12th, the US government comes out and announces a massive green harvest is on the way. You'd think prices would tank, right? Well, they went up. So to figure this whole thing out, we've got to look at what the market was seeing versus what the official report was actually saying.
I mean, on the surface, this makes absolutely zero sense. More supply should mean lower prices, period. It's the most basic rule. And that reaction, that's the big mystery we're going to unravel today. Why in the world did a report that should have sent prices crashing to the floor actually cause them to rally? Okay, so to really get a handle on the market's bizarre reaction, we have to start with the official story. We need to look at the actual numbers coming out of the US Department of Agriculture, the very numbers that were supposed to be such bad news for prices. So first up, let's break down that official USDA report. Because, on paper, it laid out this absolutely undeniable case for a gigantic, price-crushing supply of grain.
Now, this is where it gets really interesting because there's a little bit of nuance here. You see, the USDA did slightly lower its forecast for how much grain they'd get per acre compared to August. But, and this is the absolute key, they also found 1.3 million more acres were going to be harvested than they'd previously thought. So what was the result? The grand total, the total production number, was actually revised higher.
So the takeaway here is pretty straightforward. All the official government data was pointing to a record-smashing amount of corn. And, by any conventional logic, prices should have just fallen through the floor. But they didn't.
And this is exactly where our story takes a major turn. See, the answer wasn't hiding in some government spreadsheet. Nope. It was out in the fields, in the dirt, and under the sky across the American Midwest, where a totally different story was playing out.
You see, the market didn't trade the report that came out that day. It traded what it was convinced the report was missing. This whole thing wasn't about the numbers that were just released. It was all about the numbers that traders believed were coming down the line.
The growing season had actually gotten off to a pretty good start. But then a severe lack of rain, what people call a flash drought, hit huge parts of the Midwest. And it hit at the absolute worst possible time, right when the crops desperately needed that moisture to finish developing and, actually fill out the grain.
And the people on the ground, the farmers, the analysts, they were seeing this firsthand. As one analyst, Matt Bennett, put it, from a distance, the number of pods on the soybean plants looked incredible. But when you got up close, a lot of those pods were empty. They were flat. They just weren't filling out with actual soybeans because the plants had simply run out of water. They couldn't get to the finish line. There's actually a name for this phenomenon. It's called a fundamental rejection. And it's a pretty rare and powerful thing to see. It's that moment when the entire market as a whole basically looks at the official data and just says, yeah, thanks for the numbers, but we're not buying it. We don't believe you. So that price rally, it was really just a massive collective bet. It was a bet that this September report was flat out wrong. And that the real story, the much smaller, drought-damaged crop, was going to come out in the October or November reports.
But hold on, because the story doesn't just end with a drought in the Midwest. There's another huge piece to this puzzle, and it adds a whole new layer of complexity, especially for soybeans. We're talking about global demand and really one country in particular. Just look at this chart. It shows this stark, split reality for American farmers right now. On one hand, corn exports are absolutely booming. They're off to their second best start in a decade. But on the other hand, soybean exports, which relies so heavily on China, have just cratered. We're talking the worst start since 2008, all thanks to the ongoing trade war.
So this creates a huge dilemma, right? For soybeans, it's not just about a supply problem anymore. It's a massive demand problem. I mean, even if the drought does shrink the U.S. crop, the even bigger question is, who's going to buy it? Brazil is more than happy to step in and fill that void in China, and the window for the U.S. to make any sales is closing, and it's closing fast.
And this feeling of deep uncertainty, it wasn't just stuck in the grain markets. Oh no, this volatility spilled over and was creating chaos across the entire agricultural sector, hitting other key markets too.
Get this. On the exact same day that grain traders were betting against the government data, the cattle market took a nosedive, selling off sharply. That divergence tells you a lot. It really highlights just how nervous and on edge the entire ag sector was, with the grain guys making this very specific, very unusual bet against the official numbers.
Okay, so let's pull all these threads together. What does this totally bizarre day in the markets, this great grain market mystery, what does it really tell us about how all this stuff actually works? So if you follow the logic, it's pretty clear. Step 1, the government drops this bearish report. Step 2, traders look out their windows, see the drought, and compare it to the data. Step 3, they decide, nope, the official data is wrong. Future reports are going to be smaller. And step 4, they start buying, betting that prices have to go up. It shows you that markets aren't just reacting to today's news. They are constantly trying to price in what they think is going to happen tomorrow, next week, next month. They're like these giant forward-looking machines.
So at the end of the day, this really wasn't a reaction to the data. It was basically a vote of no confidence in the data. The market looked at this record harvest on paper and said, we bet the reality, what actually shows up in the combines, is going to be a harvest of disappointment. They traded the story they were hearing from the fields, not the one they were reading in the spreadsheets. And that really leaves us with a pretty fascinating thought, doesn't it? If markets can just decide to bet against official data for something as real as crops, what does that mean for all the other economic forecasts that shape our world? It's just a powerful reminder that behind every single official number, every forecast, there's this really complex world of human experience, gut feelings, and expectations that's really driving the final outcome. Thanks for tuning in.